Tonight on Market Call, we've got Jeffrey Olin, President and CEO of Vision Capital Corporation. He'll be taking your calls and emails on Canadian real estate investment trusts and real estate operating corporations. Good evening and welcome to Market Call tonight. I'm Mark Bunting. Thanks a lot for joining us to talk about REITs and real estate operating corporations as well. If you'd like to join the discussion, you can call us toll-free at 1-855-326-6266 or send an email to marketcall@bnn.ca. Nice to see you, Jeffrey.
Thanks for having me.
So tell us about this real estate market across Canada. You seem pretty bullish. It's in good shape?
The fundamentals are outstanding. We have basically supply and demand in balance, which means low vacancy rates in virtually every real estate asset class in virtually every region. We've seen some new supply in Calgary and Toronto, but so far it's been absorbed, so the fundamentals are sound.
Can you give us a reason as to why, or reasons why things look so good right now?
I think there are a number of factors. It starts at the macro level, macroeconomic level. We have jobs, which is a key driver for all aspects of the economy, but particularly real estate, that have surpassed the pre-recession level. We haven't had new construction. Debt levels are manageable. We have very well managed companies. The banks have been conservative, and so the market conditions are strong.
And you're saying this applies to pretty well most regions across the country?
Pretty much most regions and most types of real estate, whether it be office, retail, industrial, residential. We have CMHC just came out with their market vacancy rates. The vacancy rates are down. We have office vacancy rates down. We have rents that are starting to increase, and so they're pretty sound. We've seen some new supply in Calgary. Condo market in Toronto continues to be very buoyant, but so far the absorption in Calgary has been better than people expected, and the condos in Toronto are being sold.
You've been in this business for quite a while, Jeffrey. Have you ever seen a time where the market looked to have so much potential?
I think the market, in terms of the stability of supply and demand, it's about the best I've seen in my career. The question is, what degree is there growth? And I think we're in pretty good shape in this country, but the rest of the planet is in sound shape. So the question is, how much growth will we see from here? And we still see some growth, but I've seen periods of time where we've certainly had higher growth. And we're looking at regions of the country where there is higher growth, or we believe there is, such as Alberta.
Would you say that we're kind of on an island here in a sense? Our local real estate market right across the country is strong, and we have, in a way, decoupled from the rest of the world? Is that safe to say?
It's hard to say you completely decoupled because, particularly these days, you're not an island. But I think that's a fair degree that's the case. And there's some other macro factors, such as our commodity-driven economy, which I don't think is going to weaken substantially in our view. We're very bullish in Alberta because of the oil sands and having the second largest oil reserves in the world next to Saudi Arabia, and the other top 10 names on the list aren't too friendly to the United States of America. So we think we're in pretty sound shape here, and the rest of the world is recognizing it, perhaps even more so than Canadians.
How so? Are you seeing a lot of foreign money come into the market?
We're seeing foreign money coming into real estate. You're seeing foreign money going into other asset classes, but absolutely you're seeing foreign funds come in, and we're seeing values that are strong. Capitalization rates, which is a reflection of value, are down, meaning values are up. But we think they're supportable based on the net operating income that you're going to see from the properties on a go-forward basis.
We're going to start taking questions for you in just a second, but I just want to ask you lastly here, as we wrap up this segment, you're going to talk about your top picks later, but aside from those, where are you seeing the opportunity specifically?
We're seeing, we're stock pickers. We look at the top down in terms of macroeconomic and regional factors, and amongst those we're seeing a lot of strength in Alberta. So we have a disproportionate amount of our portfolio based in Alberta. We're seeing a lot of strength in the retail sector from the plethora of retailers from the United States and elsewhere. I mean, Target is getting a lot of buzz, but there are others. So the retail sector has been very strong. We're under-retailed compared to the United States in terms of the amount of square footage per person in this country, and so it's strong. Office has started to come on strong because of the job growth, and the service economy is strong. So we're seeing it, significantly across the board. But we're stock pickers. We've also seen values come up. So the sector is, on average, trading, fairly priced. But Our strategy is to look at inefficiencies in the marketplace by various factors, such as what we've talked about in the past, fever for yield,
right,
which create distortions and create opportunities for folks that at least think they know what they're doing and take advantage of.
All right, Jeffrey, we'll take a short break here as we go to break and come back after that with questions from you on real estate investment trusts and real estate corporations. We'll take a look at the impressive returns from Jeffrey's fund. Let's start with an email from Dave in Fort St. John, BC. This is on Kimco Realty Corp. KIM is the ticker in New York. He says, I've held a small position in Kimco REIT for 9 years through thick and thin. I've heard that U.S. REITs are overpriced relative to Canadian REITs, and I'm wondering if I should buy more, hold, or sell Kimco and maybe move into some of the Canadian REITs. What do you know about this, the Kimco?
Well, Kimco is a very large U.S. Shopping center REIT. We don't know it extremely well, but we know it. We've met management, and we think that management's lost their way there a few years ago. I mean, they basically panicked, in our view, during the credit crisis, diluted shareholders, if I recall, about 40% at the worst time when their share price was very low. They were trying to do too many things in too many markets, and we think that Dave, the writer of the email, has got it right. We think that the U.S. is overvalued relative to Canada, and the opportunities in Canada are compelling. The U.S. retailers are coming here, so why wouldn't Dave look at some of the great Canadian retail names? And there are many of them, First Capital, RioCan, Callaway, Retrocom, many good names, and we'd encourage Dave to look to invest in Canada, where we think he'll see more compelling returns with less risk.
Do you hold any U.S. REITs right now?
We do.
Yeah? Like Boston Properties, maybe, or?
We're in the middle of accumulating some U.S.
Okay, which you'd rather not name, I guess.
Indeed.
Yeah. All right. Joanne is in Toronto with a question. Go ahead with your question. Go ahead.
Oh, hi. I wonder if you'd be kind enough, please, to comment on Hamburg Canadian REIT.
Certainly.
Thank you.
We're not a fan of Hamburg. Again, it's based on management and major shareholders. We think we like REITs where there's better alignment.
So meaning management doesn't own enough of the shares,
or they're not. They should be not fee driven, but aligned both in terms of share ownership. Mr. Hamburg, who is a very shrewd entrepreneur, has many different real estate ventures. If we could be at the same level of ownership and interest as Mr. Hamburg, we'd probably do very well. But if buying Hamburg REIT, you're not there. So we would say sell Hamburg REIT.
Okay. Robert is in Midland, Ontario. Good evening, Robert. Hi, Robert. Go ahead. He may not be there. He wants to know about Primaris REIT.
Primaris REIT is a name that we think is going through a dynamic phase of positive change. They're in the retail space. They own some regional shopping centers, and we think that they were a big beneficiary of Target coming to Canada in the first round of announcements. They have solid management. We own it. We recently made some purchases in Primaris REIT, and we think there's going to be a revaluation of Primaris REIT, and hence our recent purchases.
I think you've mentioned Target 3 times now. Does that move excite you, or does it intrigue you, or have you positioned yourself based on the fact that big retailer is coming here?
Yeah, I mean, I don't want to overplay it. It's significant. It's significant in itself. It's significant in terms of the ancillary effects it will have on the shopping centers that Target is going to. It's symbolic of, as I say, a number of other retailers that are coming to Canada. But you don't think you should overplay. There'll be some losers from Target coming as well. Mm-hmm. Unfortunately, some of the smaller, more independent retailers probably will be hurt. And so there's a balance, but certainly that's one of the factors that we invested in anticipation of, and we monitor it closely.
Which REIT is the biggest winner because of Target's coming here?
Well, RioCan's a big winner,
mm-hmm.
For sure, in the first round. But there's another round to come, and RioCan did very well. in the first round. Some of the others that had Primaris was a big winner as well, and some of the ones that expected to get their fair share of target haven't materialized yet, but the game's not over. I think you're going to see a second round in September and some other winners from that. And the question is, what's a winner? Are you a winner of target? Well, if the economic terms are attractive to you as a landlord and you get a good tenant, you're attractive, it's positive.
All right, Jeffrey, a short break. More questions from you on real estate investment trusts and real estate operating companies right after this. Here's an email from Clint on Leisure World Senior Care, LW in Toronto. He says he's looking for something defensive that will provide a dividend. Would you suggest accumulating Leisure World at this price point?
Well, I think you hit the writer of the email hit the nail on the head. I think it is a defensive name. I think it does have a good yield to it, a good income. Not a reason to buy any particular name in our view and our philosophy, but in this case we think the yield is sustainable. It's defensive. It's in the nursing home sector primarily, although recently expanding in the retirement home side. It's focused in Canada, so it's escaping some of the problems in the U.S. Nursing home and the volatility in that space. Management is strong. Their operators, the board is sound, and I think this is a defensive name. You go to sleep and you can count on that distribution.
And it's got an 8% yield.
Yeah.
And you said you own it, right?
I own it personally.
Yeah, okay, personally.
Our fund has owned it. Mm-hmm. We don't own it at the present time in our fund, but I do own it personally.
All right, well, that's a good recommendation. Mara is in Toronto with a question for you. Go ahead, Mara.
Okay, Mr. Olin, my question is on FCR. I noticed that the share price is going down, and maybe it's because they're issuing too many debentures. Do you have an explanation for this? I will hang up and listen.
Certainly. Well, we know First Capital Realty extremely well, and it's one of the best managed, best positioned public real estate companies in Canada. Very strong alignment and ownership. Dory Siegel, the CEO, is one of the great Canadian success stories in this space. I'm not sure the share price has been going down. Maybe it did recently, but it's pretty strong. You can see that on the chart. The fact that they're issuing debentures, we would say, is a positive, not a negative, because they don't have high debt levels, and I'd rather see them issue debentures when they have debt capacity than issue additional equity and dilute investors. The dividend is solid. You can count on it. They are involved in value added, means they create space, new development, bringing on new centers. They have a lot of new value added programs coming on, and they do a good job for shareholders. So this is a core holding, and you know, it's fairly priced. I'm not sure the CEO would agree with me now, but relative to the sector, but you know, this is a solid name.
And as anchor tenants, does it have a lot of, say, the likes of Loblaws and Shoppers? And
well, thank you for mentioning that. Yeah. What is unique about First Capital is their focus on grocery store anchors and pharmacy anchors to their shopping centers, and that creates a great deal of stability. They call it the necessities of daily life. Mm-hmm. And so irrespective of economic conditions, you can count on First Capital shopping centers to be well leased and well visited by consumers.
Right, so lots of traffic for sure. Chartwell Seniors REIT is the next one we'll talk about. This is an email from Jim in Victoria. I know the market is, well, let's just say, I bought Chartwell Seniors around 9. Is this going to 0 eventually? Should I sell this and take the loss or hold it long term for the dividend? Help. Jim seems a little concerned out there in Victoria.
Well, firstly, it's not going to 0. That I'm confident of. I mean, Chartwell is a larger name. They're in the seniors housing space. They've had some challenges. They've had some changes in management. I think currently they're faced with some challenges in the United States. They're trying to address those. You know, demographic profile of the aging population benefits Chartwell and others. It wouldn't be our favorite name in the space. In fact, I personally would think one of the earlier emailers had it right. Mm-hmm. I would switch from Chartwell to Leisure World.
Leisure World, yeah.
It's a more safe, if you're looking for dividend in particular, I think you get the soundness of the dividend in Leisure World and can rely on that without some of the volatility of Chartwell.
Right. Okay, Jim, I hope that's the help you were looking for. Let's look at an email now from Roberto on Plaza Corp retail properties on the venture. What does your guest think of Plaza Corp? Does it have room to run, or should I get out now? Now, this is on the venture, smaller company, presumably. Do you know much about Plaza Corp?
Know it well.
Yeah.
Again, one of the jewels in the Canadian retail shopping center landscape. The CEO and major shareholder, Mr. Michael Zakuta, he's second to none in terms of capabilities. He's a great developer, so he creates value as opposed to just clips coupons. You know, the challenge with Plaza Corp is it's for us is that it's not the largest market capitalized, so it's harder to get in, harder to get out. We've owned it personally over time. We don't own it right now. Great company, great management. Would not hesitate to own Plaza Corp. I'm not sure it's going to run, but I think it's not going to fall either. And there's some new events going there. There are significant. They're internalizing their management, which is a significant positive. I think you're going to see greater coverage from Bay Street on this name, which may highlight the strength of the management team. And
so maybe we would see some more volume, because right now the average volume is under 7,000.
Yeah.
For a retail investor, does that present some risk, as you said, tough to get in and out if you're looking to take a fair amount of it?
Well, if you're a retail investor,
Yeah.
I think you can get in and out.
Mm-hmm.
I think you're going to see that one of the reasons they are internalizing is to try to make this more appealing to both institutional and retail investors. And by the way, their focus is in the eastern part of the country, so they're very specialized, and they have a significant influence in the markets that they operate in.
Mm-hmm. Just a bit of time before we take a break and get to your past picks. What's the one error that you think people may make when they're investing in REITs that you maybe bump into or run across every now and then?
Their focus on yield. Mm-hmm. You know, folks can go to the bank to borrow money to pay you a distribution. Don't look at one of the blessings of real estate is that it's cash flow driven and it has the potential to pay a distribution or a yield or dividend. But that doesn't mean you should value it based on the yield. Because it's two companies that have the exact same cash flow. One pays out all of it as a dividend, the other one pays none. Are they valued any differently in the real estate marketplace? No. Do retail investors value one with the yield more highly? Yes, and that's one of the distortions that our fund likes to take advantage of.
Okay, so you want to don't get sucked in by yield.
Exactly.
Basically. We'll take a short break here. We will get to the past picks of Jeffrey Olin right after this. They are all winners. Come back and find out what they were after this break. Jeffrey Olin was on this show back in January 18th to be specific. He, of course, is the president and CEO of Vision Capital Corporation. He's selected 3 REITs, and the average return here is 22%. Pretty healthy. Main Street, you recommended at 15.45, up around 7%, including the distribution, which I'm assuming it has. Why this one? And you're still holding it, right?
Yes, firstly, it doesn't have a distribution.
No distribution? Okay.
Main Street is a unique entity in Canada, certainly in public markets. They're focused on the acquisition of undermanaged, beat-up apartments in the mid-market sector, above the radar screen of mom and pa's, below the radar screen of institutions. They look to reposition the apartments, re-tenant them, increase the rents, refinance them, and have grown the company from 272 apartments in 1998 to 7,300 today, with $10 million in net equity. The net asset value, we believe, is in the range of $25. The company believes it's in $30. It's trading at $16.50. It is absolutely unique in terms of a value creator. The CEO, Mr. Bob Dylan, is a Canadian success story, and you know, he's basically, as a number of our names, it reflects the same thing. He's growing the top line cash flow. The number of shares are decreasing, so the cash flow per share is going up. And we have significant expectations for further gains in this name.
I remember you mentioning Bob Dylan before, and I won't make a silly joke about his name. This is also a top pick of yours, so you'll have more to say about Main Street later. Morguard Corporation, $48. Nice return here, 48%. What is it about Morguard that you, presumably were owning it prior to recommending it, but were you expecting that kind of a boost on the stock?
Yes,
Yeah.
and we're expecting a lot more. You know, Morguard is a large entity. They have 18 million square feet primarily in Canada, but also in the United States. They're diversified. They're a significant player in the asset management side. One of the factors that have impacted the market is IFRS, the new international financial reporting standards, accounting standards,
right,
requiring you to publish the market value of their properties. They blew everyone away, including us, by publishing $133 per share of the value of their portfolio looking backwards. So we think this name has a long way to run. And again, both this name and the prior name had no dividend. This has a small dividend. Goes back to your question. We're looking for value and total return, and we're seeing it in some of the names that we're highlighting.
All right, fascinating. And let's spend some time on a Retrocom mid-market REIT. Ticker here, RMM.U. 542 is where you recommended this one, up by 12%. What can you tell us about Retrocom?
Well, Retrocom does have a yield. It's a juicy yield. It's about 7.5%, but again, don't value it based on the yield or any entity. In the retail space, secondary markets, what we like about this is they have a number of properties where there's an opportunity to redevelop them and expand them and make them higher quality properties. And they have a sponsorship through the ownership of Mr. Mitchell Goldhar, who owns Smart Centers, the guy that brought Walmart to Canada,
right,
and the major shareholder of Callaway, owns and has voting control of about 25%. And we think they can leverage the expertise, talent, and resources of the Smart Centers team to take advantage of the opportunities within the portfolio. And so you have to value this not just on what the cash flow is today, but what the cash flow is going to be tomorrow from the upside from some of these properties.
So Retrocom Mid-Market REIT, Morguard Corp, and Main Street Equity are your past picks. Again, the total return average 22%, and Main Street and Morguard are also top picks as I sort of show the strings and let the cat out of the bag. But you can look forward to more information from Mr. Olin on those two later on in the show. We've got half an hour to go following this break, and we've got calls and emails all lined up for Mr. Olin, but there's room for you if you want to give us a ring and ask a question about a specific REIT or a real estate operating corporation. Come back after this. We've got John on the line. He's in Markham, Ontario. Good evening.
Hi. How are you guys today?
Very well. What's your question tonight?
INV.UN, Real Estate Invest. I do have them. I just wanted to ask if this is a good opportunity to buy any more of these.
Invest, for those that aren't familiar with it, is focused exclusively in the hotel sector. They have some a wide range of properties. They have some great properties in Western Canada and major and urban centers. We think they're well positioned as the economy continues to improve and travel conditions improve. We have owned it. We don't own it at this presently, but in this range, it's got a nice yield to it for those investors that are focused on that, which we are not. But I would not hesitate to own it if you do own it, to hold it.
Jeffrey, among the REITs in the various different sectors, would you say, I'm not putting words in your mouth, but I'm just asking, is the lodging sector maybe your least favorite or no?
I wouldn't say it's our least favorite. It's certainly one that we spend less time on. I mean, basically in the hotel sector, it's more of an operating business. You can do the best real estate deal in the world, but if you're not a good operator, you're going to lose money. And historically, it's been the operators, the management companies, the Hiltons and the Marriotts that have made money in the hotel sector, not the owners of the properties. There are exceptions to that. And you've got to recognize you basically have a tenant with a one-night lease.
Mm-hmm. Right.
So.
Okay, let's talk to Trevor, who's in Victoria, BC. Hi, Trevor.
Hi. Just wondering if you can give me your thoughts and opinions on Extendicare REIT.
Certainly. Extendicare is focused in the nursing home sector in both Canada and the United States. We've avoided extended care because of what I mentioned previously, a great deal of volatility in the U.S. market in this space. Legislation changes. There's a lot of litigation in this space. And so we'd encourage you to focus on Leisure World, which is a similar business but focused in primarily in Ontario, but a Canadian name without the U.S. exposure.
Not just for extended care, but in the United States, do you shy away from that market somewhat? You said it's overvalued, but is there a lot of regulation, red tape, litigation that makes you shy away as well?
No, not at all. I think certainly in the nursing home sector was a specific comment, but you know, we certainly have greater expertise in Canada, but we have U.S. names. We've had a lot of experience in the U.S. I mean, Brookfield, which is a great Canadian company, generates, I believe, 40% of their net operating income from Midtown Manhattan. Yeah. So we, you know, we focus on supply and demand fundamentals, which are better in Canada, and valuations, and you know the valuations are high. And you know, I've had a great run in the United States and in Canada, but we believe the opportunities are more compelling at this time in Canada, but that can change.
Right. A short break here with Jeffrey Olin. He's taking your questions on real estate investment trusts and real estate operating companies. More of your calls and emails after this. Louise is in Canmore, Alberta with a question. Go ahead, Louise. Hi, Louise. Hello, Louise. Last chance.
Hello.
Hi, go ahead with your question.
Could I have your opinion on Dundee REIT, please?
Certainly. Dundee REIT is a diversified commercial REIT. They have a significant presence in Western Canada, Alberta, which punished them about a year or two ago. They've diversified their focus in Eastern Canada. At the same time, the Alberta markets has improved. You know, we know the entity. We don't own it right now. We would like to see better alignment between the sponsors. I'd like to have the sponsor is the Dundee family and Ned Goodman. I'd rather own Dundee Corp because within Dundee Corp you can get access to Dundee Real Estate, Dundee Realty, the private company. And I think management divides their time between the various entities, and so we don't own it, but it's a high quality name.
But you're not compelled to own Dundee Corp. No,
I'm just saying within Dundee, which has a lot more than real estate in there. Yeah. So it's not. I wouldn't want to say Dundee Corp is a real estate name, but embedded in there, we believe there's a significant amount of value from Dundee Realty. And if we had our druthers, which we don't, we'd rather own Dundee Realty, and because that's the value creating entity as opposed to the coupon clipping entity that's throwing out a yield to deal with the broad market.
Have you talked to management in the hopes that they may spin it out at some point? Have you suggested it to them?
Not recently, but I'm not sure they need our or would welcome our suggestion in that regard.
All right. Let's talk to Mike now. He's in Victoria, BC. Hi, Mike.
Good evening. I'm an income investor, so I am interested in the yield and looking for a relatively good yield in a stable company. So I'm looking at Crombie, and I'd like to get your comments on it.
Again, Crombie has a focus in the retail sector as well in Eastern Canada. Would not be our favorite name. There are many high-quality names in retail in Canada we think are better. We've talked about some of them already, but we think management is sleepy. We think there's deferred maintenance in their properties. You know, we think there are better names that can provide you with yield. We've talked, if you're looking for a high yield, Retrocom, which we've mentioned we own. First Capital is a solid name. RioCan is a very stable name. Callaway, Plaza Corp was spoken to earlier. We think all of those names, in our view, would be in preference to Crombie.
All right. Bill is in Waterford, Ontario, with a question. Hi there, Bill.
Hello there, gentlemen. I'd like your opinion on Temple REIT, please. It's one of my riskier REITs, and I like the distribution, but I don't know how the debt is on it. So I'd like your opinion, please.
I'm sorry, you don't know how
He doesn't know about the debt situation with the company.
Yeah, Temple REIT is a high-risk, high-reward situation. They do have a nice dividend, but again, don't invest on it, particularly if you're relying on dividend for the dividend here. They're focused on the hotel space again. A lot of questions on hotels here this evening. They're leveraged to Western Canada, and particularly one market, Fort McMurray. So if you're bullish on Fort McMurray, Temple REIT's a good place to be. They had some struggles, as the caller mentioned, in terms of high-cost debt. They put a fair bit of that behind them. We know management extremely well. They do own a fair number of units of the REIT. We've recently begun to look at this name anew, and it's a high-risk, high-reward name.
Is it too much of a one-trick pony because it is reliant on Fort McMurray?
It is a one-trick pony. I'll let others decide whether it's too much of a one-trick pony, and hence there's some risk in that regard.
I guess it ebbs and flows with the cycles out there and how the
exactly.
oil and gas sector is doing. Let's look at an email on Canadian apartment properties from Renee, who's in Toronto. What is Jeffrey's view on Canadian apartment REIT? Is this a good long-term play, or are there better REITs to consider?
Again, if you're looking for stable, I'm able to go to sleep at night, REIT with outstanding management, CAPREIT's a good name. Tom Schwartz, who I've known for many years, is an outstanding executive in this space. He's got a lot of value-added skills. It's a large cap. They own apartments with a focus in Toronto, a significant amount. They're across the country, but they have a disproportionate amount in quality buildings in Toronto. So people like the apartment space as a defensive name. So the distribution is reliable, and we think it's a high-quality name. And if you're looking for yield, it's a good one.
Which REIT runs apartments the best in the country? Is there a Boardwalk or the one you just mentioned? It's hard to say.
I think there's a number of high-quality management teams. Certainly Boardwalk has a strong management team. CAPREIT has a very strong management team. We would think those are probably the two granddaddies. I mean, Main Street we think has a good management team. It's getting better, and we'll come back to that later. We think Main Street is a better value creator, and probably on a total return basis, we have a lot of upside in our outlook for Main Street. But there's, TransGlobe is less of a favorite of ours in terms of management, less alignment, externally managed REIT. So even if they have good management, which we're not so sure, they're not aligned. CAPREIT, Boardwalk, Main Street, you're getting alignment.
Okay, Jeffrey, a short break, and we'll keep taking questions for you on REITs and real estate operating corporations right after this. Let's head out to Halifax to talk to Mike. Good evening.
Hello.
Hi, Mike.
How are you tonight? I'm here.
My question for your expert tonight is with regard to Northwest Healthcare, which I've owned for a number of years, and it's not going anywhere, although it does pay a fair dividend. What's the future?
Certainly. Well, Northwest, I'm not sure you've done a couple of years, because I think they IPO'd last year. Northwest is focused in medical office buildings exclusively. We think they have strong management. They do have a reasonable yield. I think it's about 6.5%.
Yeah, you nailed it.
And on that, they have what a low payout ratio means that they're not overpaying their distribution, paying you back with your own money. So it's somewhat defensive in that regard. We like the space. We like the sector. We don't own Northwest at the present time, but we think it's a good name.
So not knowing Mike's strategy or what's in his portfolio, you figure you should hang on?
Yes.
Yeah? Okay. Len's in Brampton, Ontario, with a question. Go ahead, Len.
Hello there, Jeffrey. I'd like to have a comment on the Artis REITs. They've been hanging in around the $13, $14 to invest for income, $50,000. Is that a very safe investment, and how well is it rated in the REITs?
Well, Artis is increasingly one of the larger cap REITs. We know management, they're strong management, but they're not aligned to the degree we would like. They have external management. The market's been waiting for them to internalize the management and align their ownership. They announced that they will do it, but not yet. And the terms upon which they will do it have not been disclosed. And hence their alignment has been to grow the scale of the REIT, not necessarily the profitability. And so they've been had a voracious appetite to issue capital. They've issued hundreds of millions of dollars of equity and debt capital in the last year. And every time the units pop up, they go out and buy some more properties and issue capital to finance them. And so we would like to see management own more units. We'd like to see internal management. And if we could apply the skills that we know management has to the benefit of unit holders in a aligned way, we would probably own this REIT. But, you know, so that they're overpaying their distribution. Again, they're playing into the yield fever, which is not something we like to see. So we would call this a hold. Some caution because they're overpaying their distribution, but they're going to grow into it.
All right, let's look at an email on Pure Industrial REIT. This is from Glenn in Winnipeg, which got its hockey team back officially today with a rubber stamp from the NHL. What does your guest think of Pure Industrial REIT, and how is their debt level?
We like Pure Industrial REIT. Again, a transformational announcement in the last couple of weeks of Pure Industrial REIT where they are internalizing their management. So exactly what we want to see, and they're doing so at no cost to the REIT, although the initial transaction, the IPO, there was some consideration for the ultimate internalization that is now being realized at no cost. We like it. They're focused exclusively industrial, so they're a pure play. They're unique in that sense. You know, management is strong. We think getting stronger with the current play. We do own some Pure Industrial REIT.
Now we'll look at an email from John on Cominar. Could your guest comment on this company? I want it, or trust. I want it for income with a long-term hold. What do you think of Cominar?
Well, then you've got a good investment. Cominar is focused in Quebec. They have a dominant market position in Quebec. The Dallaire family, second generation of Dallaire family ownership now. They know what they're doing. They're solid. It's reasonably valued. You can count on the dividend distribution. It's a REIT, so the distribution. And if you're looking for income with a long-term hold, you're in a good place.
All right, we've got a bit of time before we take a break for top picks, rather. I want to ask some general questions about your fund. We showed your fund a little while ago on the returns the last couple of years against your peers and benchmark. But since inception, your main fund is up how much?
121% since July 2nd, 2008. So 3 years.
Since July 2008. And that's pre-Lehman Brothers. And
that's pre-Lehman Brothers. We didn't know what was going to happen any more than others, but we were quick to make a transition. My partner, Frank Mayer, who was a top-ranked analyst, and I, there's two of us. We can make decisions quickly, and we made some decisions quickly to get repositioned for what we saw happening, not in July, but as we saw credit conditions and we moved into debt and cash, and so we withstood the downfall fairly well and recovered. We took advantage of the downturn to position the portfolio well. Although we did very well coming out of it. It was 2010 last year. We're the top performing hedge fund in the country after the recovery. So we're not. We certainly just didn't take advantage of the downturn. Our performance has been fairly consistent.
Yeah, no, for sure. And aside from the things that you mentioned earlier in the show about how you select real estate trusts or corporations, is there not a secret, but anything you're not divulging or telling us in terms of your strategy or how you pick them? Because that's a heck of a return.
Well, we talked about supply and supply and demand, but the key metric we look at in valuation is what is the net asset value of the real estate underlying the public company. Is it trading at a premium or a discount, the pricing of the security, premium or discount to what the value of the real estate is, and tomorrow, not today.
Yeah.
So we're looking at forward-looking valuations of net asset value and making our investments and or growth. One of the names we're going to talk about, we're really excited about, is growth. So those are the things we're looking for. Fair value, where the growth is coming from, make sure you're in the right regions of the country, the right asset classes in terms of what's going to benefit the marketplace.
So a lot of what you do is value investing to a degree.
Absolutely.
Yeah. All right, let's squeeze in one email here from Shobana in Mississauga on RioCan. Can you give me your opinion on RioCan? You mentioned granddaddies among REITs. This is one of them.
This is one of them for sure. Outstanding management, breadth of top talent, Eddie Sunshine, the entire team, the leasing team, Freddie Wax.
We had him on BNN just the other day, Mr. Sunshine.
Besides being a very dynamic and nice man, he's a very capable guy. I mean, if you're a U.S. retailer and you want to come to Canada, they're pretty much the first call that you're going to make because of their influence in the marketplace. They've got the scale. They're a solid entity. They're a big winner from the target. They took a very interesting strategy to try to, and worked to get a disproportionate amount of the target stores coming to Canada. And so, again, as a total return, we wouldn't necessarily be our top pick, but if you own this name, again, and you're looking for income, it's a solid name. And they, by the way, have taken advantage of their scale and their access to capital. They're moving into the United States in an opportunistic way. Increasingly.
Do you think that'll be a successful foray for them?
I think so. They're pretty shrewd. We were down. One of the things you asked what our difference is, we like to tour properties. We don't like to make investment decisions sitting on Bay Street. We were down in rural Pennsylvania last week looking at some of the joint ventures that RioCan has with Cedar Shopping Centers, one of the U.S. names.
Right, yeah.
And so they've been opportunistic, and we think they will continue to be opportunistic in the United States. And these are experienced guys. They've seen the depression in the real estate world in the early 90s, as I have, and they survived as we did. And I think I don't think they'll make the same mistake.
All right, Jeffrey, a short break here. We'll come back and take a look at those top picks of yours. Here come the top picks from Jeffrey Olin. He's the president and CEO of Vision Capital Corporation. Now, this is one you've mentioned before here, and I probably named it as a top pick previously. Edluin Group, EDU. They're in education. I know you like them a lot, and you also have some sort of affiliation with them, do you not?
I sit on the board of directors of the company. Our funds are collectively the largest shareholder. We own about 15% of this company. It's one of the more exciting investment opportunities we've seen in Canada in a decade. What Edluin is doing is they're consolidating the child care industry and building new child care centers across the country. And basically, Canada is the last Anglo-Saxon Western economy in the world which hasn't gone through a consolidation and a professionalism in the child care area. It's happened in the United States. They consolidated. They went public. And in major transactions, entities like Morgan Stanley and Bain have privatized these entities at 12 times EBITDA multiples. They've assembled a management team from Australia and United States to do this. They've tripled their growth in the last year from a standing start. Analysts have targets between $1.75 and $3 a share on this name. We think those again, this is a long-term investment for us, and we think those targets will prove to be conservative. We're very excited about this name.
All right, very good. High recommendation there from you. Now, two top picks here were also past picks. We'll get more detail from you here on Morguard Corporation, MRC.
Well, we talked about Morguard previously, but just to highlight the valuation for you, borrowing some of the analysis Frank put in my pocket before I left the office. Presently, Morguard is trading at roughly a 7 times price to cash flow multiple, so the equivalent of price to earnings in the real estate speak, versus the sector at 15 times. That's as is. But one of the things Morguard owns is 45% of the units of Morguard REIT. Morguard REIT, because it's a REIT and has yield, is more fully valued. If you take out the cash flow from Morguard REIT from the numerator, and if you take the ownership of the units from the denominator, that price to cash flow multiple is actually about 5.5 times. So it's trading at 1/3 of the multiple of the sector. You want to look at a net asset value, which is what we said we primarily used. It's 45% discount to net asset value, and if you take out the Morguard REIT, 65% discount to net asset value in an 18 million square foot company. So that's
so you think it's way undervalued right now?
Way undervalued.
Yeah.
Way undervalued.
Interesting. And Main Street Equity Corp, MEQ, you mentioned this one as well. Oh, here it is. Bob Dylan is spelled differently, so it's not, can't be the singer. Yeah, so Main Street, to give us more detail here.
So,
another one discounted to its peers, too.
Yeah, significant discount, trading at $16, $50, $17. We're somewhere between $24 and $30 a share. They had some operational challenges. Their vacancy rate was high as 19%. They brought it down to 11%. They should be in the 4 to 5%. Every 1% reduction in the vacancy rate throws off about $600,000 or about 5 cents a share in cash flow. This company's a steal at these prices.
All right. Always great to have you here and get insight into REITs and the real estate sector in Canada. Thank you, Jeffrey. Main Street Equity Corp, Morguard Corp, and Edluan.
Edlian.
Edlian.
Acronym for Education Learning Universe.
Okay, there you go. Edlian. When you come back, I'll get that right next time, because you probably pick it again. All right. Thanks a lot, Jeffrey. Thanks a lot for your calls and emails tonight. I hope you enjoyed that on the real estate sector. We've got Stan Wong tomorrow night. He's from Macquarie Private Wealth. We know that. We know and love Stan, so we'll tune in for him tomorrow night. Do your diligence, as always, and consult with a qualified financial advisor if you're doing any investing. We will see you tomorrow. Good night.